Good afternoon, everyone, and welcome to this webinar here at TradeStation. I want to welcome you to this event. We're presenting Mr. AJ Monte, the Chief Market Strategist for the Market Guys. Today, we're going to talk about stock screening to maximize returns. AJ Monte is one of the most sought-after trading consultants in our field. He teaches professionals specialized techniques on how to accumulate and protect wealth through innovative market techniques. Today he's going to talk about stock screening to maximize returns. Our presentation is for educational purposes only. All the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. I have posted in the chat panel 2 disclosure documents, and they are in PDF handout format. You can download them here or view them on the TradeStation website at your convenience. So I want to turn things over to AJ right now to talk about stock screening to maximize returns. AJ, welcome to TradeStation.
All right, folks, thank you so much for your patience. Really appreciate that. As Don mentioned, my experience put me way back into the trading pits of the commodity exchange back in the World Trade Center when gold and silver was traded actually in 4 World Trade Center. And I had the opportunity back then to rub elbows with some of the top traders in the world, and it was really a great experience for me because at that time my degree was not in finance or anything to do with trading or Wall Street. It was in aerospace engineering, and my goal was to fly airplanes. That was my lifelong goal, and to this day I still fly, but I trade the markets. I like taking risk. I like controlling that risk. And today what I'd like to do is share with you some of the techniques that I use for screening stocks with your trading and investing. So in other words, this will apply to the traders and investors alike. The only thing that would separate those two would be the time frame. The trader is more short-term in nature, with getting in and out of a stock, where an investor has a more long-term perspective. Now, I want to tell you that the slides that I have right here, these are slides that I put together. They're based on my notes that I've taken over the years. And this is not any kind of a disclaimer that was put together by any lawyers. I put this slide up there because I want you to see the bold print underlined right there, the 1% rule for managing risk. Everything that I teach to my students, everything that I do in the markets involves managing risk. And if you think about it, the biggest part of the risk management plan is knowing which stocks to get into and knowing which stocks to avoid. So it's really not rocket science. This is a very simple process for finding stocks, but it also involves the use of the technical charts and establishing, or at least identifying, the trend. Now, again, I don't mean to teach anyone as though they're a 12-year-old child. I just want to keep it as simple as possible because my strategy is to keep it super simple so that the signals are never confused by the market noise. There's going to be a lot of news thrown at you during the course of a day or even during the course of weeks. There's going to be a lot of confusion with regard to, hey, what's happening in the market today? It was up today, it's down yesterday, what do I do? So the first step is identifying the trend and knowing that the buyers are in control when prices are going up. We call that a bullish market. And the main, I guess you could call it the main emotion that's controlling the upward price swing is, in fact, greed. In a good way. I don't mean this in a bad way. People get into the market because they want to make a profit. They don't get into the market because they want to lose money. They want to grow their money. So greed actually is a component that drives prices up. Now, on the downside, greed has no part in pushing prices down. It's all driven by the sellers who in a lot of cases are operating out of fear. And fear is actually a stronger component than the greed factor, because that emotion, fear, causes people in a lot of cases to panic. It's also known as capitulation, frustration. They just get out. I don't want to lose any more money. So fear pushes prices down. And in a lot of cases, when the markets are moving sideways, it's neither the buyers or the sellers that are in control. It's usually stocks that trade within sideways trading channels or trading ranges. And there's not that much emotion that's driving things. There's a lot of indecision, actually, but the price volatility allows us to be able to profit in the market. And what I want to do is show you when to get in and, most importantly, when to get out. So, like I said before, finding the right stock involves filtering out or eliminating the ones that we don't want to trade. And a lot of times the computer software that we have right on our computers helps us narrow down the field and saves us a lot of time in the process. And whether you're using a TradeStation platform or whether you're using Google Finance or Yahoo Finance, a lot of the websites that are out there for free will have stock screeners built in. Try going to Yahoo Finance, and you'll see that they have filters that you can overlay on top of the market to eliminate the stocks that you don't want to trade. So for instance, if you're looking for a high dividend stock, you could overlay a filter that will eliminate all the low dividend paying companies and leaving you with only the highest paying dividends. So again, it's not hard to do. You just have to get in there and start practicing and start messing around with some of the tools. Now, another thing with regard to stock screening is that we use the technical charts. I use them exclusively during the course of the day, especially when I'm looking at the market, and I look at stocks. I try to see or find the pictures within those charts that I like to trade, and it helps build some consistency in the results that I get. And I'm going to show you some price patterns that you could search for that will absolutely increase the probability of making money just by the mere fact that, let's say, for example, triangle patterns are very, very sought after by the traders, because when triangles form on the price patterns, that's something that traders actually look for, and then the triangle patterns give off signals as to when to buy or when to sell. So it makes it a little bit easier for you, the trader, to initiate the trade. Now, in the stock selection process, it's important for you to understand the idea of beta. What is beta? Well, each stock is given a beta coefficient, where a beta of 1 is matching that stock to the overall volatility of the underlying market that company is participating in. And a beta of 1.25, you can see here, that tells us that that particular stock is 25% more volatile than the underlying market. A stock that has a beta of 1.5 is going to be 50% more volatile than the underlying market. And a stock that has a beta of 2.0 is going to be twice as volatile as the underlying market. So you can see how the beta coefficient will play a hand in the stock selection process. Now, on the other side, an investor may not want to look for a highly volatile stock. In fact, they might want to look for a stock that's less volatile when compared to the market. And let's say you have a stock that has a high dividend, but you don't want it hopping around all over the place. You want it to show some stability. So you're going to look for a stock that has a beta of less than 1, because in this instance, a beta of 0.75 means that that stock is 25 less volatile 25% less volatile than the underlying market. So again, just a little thing that you could put into a stock screener to help you filter out the best candidates. Okay, now, moving average crossovers are an extremely important part of what I do. And in fact, if any of you have ever subscribed to my weekly market report, you'll know just by watching what I do that my charts will almost always have a moving average somewhere on the chart. And this is not, again, it's not a complicated concept. It's a simple moving average is basically the average price of the stock over a given period of time. So if X equals 20 in this calculation, then I'm more or less calculating a 20 period moving average. If X equals 10, then my moving average is going to be tracking 10 periods, an average of 10 periods. So you'll know over time through experience how to use these moving averages, and I'll give you some good examples on how this works. Now, folks, keep in mind that for those who are listening to the live session, you have the ability to type in questions at the very bottom. So if you have a question, go ahead, type that in, and I'll be happy to work that into the presentation and answer that question for you. Now, if you're listening to the recorded session, you can send me an email with your question, and I'll answer that as well. I'll give you my email address at on the very last page. Okay, so I don't see any questions, so I'm going to move on with the moving averages. Now, when I had my television show on PBS, that was a great experience. We had a primetime show called Wealth and Wisdom that aired primetime Friday nights right after the Jim Lair News Hour. And it was a really great opportunity because I got to meet so many different kinds of people. I had fund managers, I had celebrities on the show, I had all kinds of folks. But there was one gentleman, his name was Jim Rawbach, and Jim at the time was known to be the Zen of market trading. He, at that point, was the #1 stock picker in the world. And I asked Jim, I said, Jim, how do you stay so consistent with your stock picks? How do you, above all people, how do you stay so accurate in your percentage of accuracy? He said, well, I use a moving average. I use a 20-period moving average. That's what I use. And when the stock crosses over the 20-period moving average, I buy it. And when it crosses down below the 20-period moving average, I sell it. That's it. That's my whole secret. And he said, using that method has allowed me to become the best stock picker in the world. So I said, Jim, I'm taking good notes. I'd like to learn. And Jim was nice enough to show me that strategy. Now, as a result, I don't want to sound like I'm bragging or boasting in any way, but as it turns out, my percentage now allows me to stake that title of #1 stock picker. There's no one in the world right now, I challenge anyone to have a better percentage of accuracy than I do. Right now, my percentage of accuracy is the best in the world, and I prove it each and every week with my market reports. I'll tell you on a Friday afternoon what the following week is going to look like in the market, and I use the moving averages quite often in forecasting. So in this example right here is a stock that I pulled off my charts that is showing the blue line representing the 20-period moving average. Again, it's something that you just set on your chart and it stays there. Now, again, that blue line is a 20-period or 20-day moving average because my chart is set in daily intervals. Now, as I look at this stock, you can see that there are times when the stock moves over the moving average that I would buy it. Let me back up a little bit and show you without the arrows what I'm talking about. In the first example, and I'm going to use my highlighting bouncing ball here, hopefully you can see that, right here the stock closes over the moving average. Now please keep in mind this method is something that is used based on where the stock closes, and you could filter or screen for stocks that have their moving averages going in an upward direction. This method works best if you're a buyer to have the stock moving in an upward direction. So if you're looking at stocks and you see that the chart is moving lower and not upward, then you're going to eliminate that candidate. You want stocks that are going up. So right here you can see the stock closes just above the moving average. So I would buy right at that point, right as it's closing over the moving average. Now, a lot of times I will wait for the last half hour of the day to make sure that the stock closes over that moving average before I buy it. Right now, if we progress up, you can see that the stock has gone up, and right here I would have sold it right there because it closed below that moving average. A couple of weeks or a couple of trading days later, I would have bought it again here. I would have sold it right there for a very small loss. Now, please keep in mind, we do take losses every now and then, and that's par for the course. You want to buy and sell, and every now and then you're going to lose, but you want those losses to be very small. So if I bought when it closed over the moving average here, and 3 days later I sell it, I would have lost a little bit of money. Then I would have bought again here, and I would have sold here. I would have made a little bit of money. I would have bought here again and sold here. I would have made very little money. I would have bought again here, sold here. I would have made money. I would have bought here, sold here. Would have made money. I would have bought here, sold here, lost a little money. I would have bought here, sold here, made a lot of money. And you can see once I put all my arrows in place, green representing buy, sell representing red, you could see those places where I would have bought and sold. Again, I'm highlighting the areas where you would have lost a little money right here. Again, you would have lost a little money maybe right, let me see, you made here, you would have lost a little bit right here. You would have bought here, sold here. Very little losses, and then you would have made money here. Notice that if this was a current day chart, my green candle today would have left me with a new buy order, a new long position, and I would have been waiting for the next sell signal to get out. Okay, so this is a method that you could use, and it's also something that you could screen for by searching for stocks whose moving averages are moving up steadily. Okay, now again, if you have any questions, type them in there. I'll be more than happy to help you with that. Okay, no questions. Now, channeling stocks. What is a channel? What is a triangle? And what are breakouts? Well, I'm using stick figures here. Again, textbook examples of what a channel would look like. Again, in this case, stock goes up, hits some resistance, it comes back down. Little zigzags, right? That's how, it's actually how most stocks will trade. They'll go up, they'll come down. But what happens is in an upward channel, the successive lows here are higher. So the most recent low is higher than the previous low. The most recent high is higher than the previous high. So when you see the zigzag happening there, and you're able to draw parallel lines between the highs and the lows like that, that's a trading channel. And also, there are sideways trading channels, just like that. In fact, right now, the U.S. dollar is trading in a sideways trading channel. I could give you a whole bunch of other stocks that are doing that, but you want to search for stocks or screen for stocks that are trading in ranges, whether they be upward trading ranges, sideways, and even in a downward trading channel, you could make money. Now, with a downward trading channel, the only difference is that you would be more or less shorting on the highs and buying back on the lows. So the order in which you trade is just slightly different. For those of you who are brand new, you don't always have to buy first and sell later. You could actually sell first and buy later. Doesn't matter which order you do that, as long as your sell price is higher than the buy price, you'll make money. Again, I won't get into short selling as a strategy. That's another topic for another time. But when you're screening for stocks, you can also screen for stocks that will make you money on the way down. And that's very exciting because my forecast and my analysis of this market is telling me that we're long overdue for a major correction. And I think a bear market is around the corner. And therefore, you want to learn how to make money on the way down. Because in a bear market, if you don't change your strategy and you keep buying and holding, you're going to keep buying and losing. And you don't want to do that either. Okay. Now, this is an example of what a breakout would look like on a trading channel. And you can see here that right as the stock breaks out of this parallel line here is usually the buy point. And most traders who use this as a strategy and search for stocks that are in trading channels like this, the buy signal comes on the breakout, and a lot of times the breakout is followed by high volume bars on the bottom. And so when we're looking at a stock that's breaking out, we also want to look at volume to support the breakout idea, and that gives us a better confirmation signal. So when you buy a stock that's breaking out, you want to then set your stop price, which is your get out point, if the stock starts breaking down and going back down into this channel. So this upper dotted line that I have right here for you is the line that not only helps us with getting in on the entry point, but it helps us managing risk. Remember that very first slide I showed you? The 1% rule is how we manage risk. And please, if you could remember the website down here, just go to themarketguys.com, and I have a library of videos called Market Shots. And I think there's a slide at the end that shows you exactly where to get that. But it's all free. I give a lot of free stuff away. And the videos is just some of what I give away. And I talk about the 1% rule for managing risk. No matter which strategy you're using, the 1% rule can be applied to moving average crossover method, to channel trading, to triangle trading, to short-term, long-term trading. Doesn't matter. You have the ability to use a simple math formula to minimize your risk when things go wrong. And folks, I've been doing this now, let me see, August 15th. Well, yeah, August 15th is going to be my 35th anniversary in the markets. 35 years. Can't believe I'm that old already. But 35 years in the market, and I've been using this method. And when I took my biggest hit that I ever took in the market was in the silver markets when the markets crashed in 1987. The big crash of 87 was my big hit, and I'm talking big. I lost almost everything that I had up until that point, and I was 28 years old. And I'm telling you something, I learned my lesson, and I swore to myself that I would never, ever let the market take that kind of money from me again. And so I developed the 1% rule, which, if I were to put this in a sentence, basically what it says is you would say, okay, and then you'd say your name. I state your name, will not allow the market to take more than 1% of my account from me on any given trade. That's it. That's a 1% rule. And I have a math formula to back up that sentence. And so if I'm wrong, or when I'm wrong, I'm only going to lose a very small amount. But when I'm right, and I'm in a breakout channel like this, now I could really celebrate the success and let a stock run. See, that's a big challenge. When people are looking for stocks in whatever stock screening process they're using, they don't allow for stocks that have a tendency to run a long way and rally great distances in price. They tend to get in, they hold a little bit, and they sell too early. They sell for minuscule profit, and then for some reason they'll hold on to the big gainers, and that doesn't work for them. So they make a little bit along the way, but when it comes time to lose, they hold on to their losses, and now they give back all their profits. So I reverse that for everyone. When I show my students how to trade, it's reversing that formula. Pick a good stock, identify the trend, and enter the stock at a certain point, identify your exit strategy, and sleep at night. I mean, we don't want to be stressed about this. We want to be able to sleep at night. Okay, still monitoring for questions. I don't see any. If you do have questions, you can type them in the chat box in the bottom, and I'll see that. Okay, so next, one of my favorite is the triangle pattern. Now, the way you search for triangle patterns is you could also search for stocks that have descending volume. Because what happens is, as I'll show you, these are obviously little triangles on the screen, but this is what a triangle pattern looks like on a chart as an example. What happens is the buyers and the sellers basically fight it out. So I'm going to put an S above here, okay, representing the sellers, and I'm going to put a B down at the bottom representing the buyers. So what happens is, in this case, the sellers are pushing the stock down, and with every chance they get to push the stock down, they push it down to a lower high. You see that? And so what happens is the price tends to get squeezed into this very, very tight part of the triangle right at the very end there. And when the price gets squeezed like that, the volume starts to drop. If I were to draw volume bars here, you'll notice that the volume starts to drop like that. And that usually happens when a price squeeze is starting to take place within a triangle. So you could screen through volume filters. Even Google Finance, which is a very free product, it's not the greatest screener, but at least they could screen for stocks with descending volume. And then you find those stocks that have the drop in the volume, and then you go to the charts and you look for these triangles right here. And what happens is the sellers form lower resistance and the buyers will hold their support. Now, it's not always like a right triangle like we see here. A lot of times it'll be an asymmetrical triangle, or it might be an ascending triangle or a descending triangle. It doesn't matter. A triangle is a triangle. But what happens is the strategy behind a triangle is that eventually the price will break. And in this case, in this example, when the sellers yield, they pull back, the buyers start to move in, and then once the breakout occurs, the stock starts to move higher from there. And it's in this part of the breakout point, the price rally, where we're able to make money. Now, this is a very, very consistent and very reliable strategy, because this is the tendency. On a breakout, the stocks tend to move very, very quickly. So if you buy on the breakout point, and I'm going to use my bouncing ball here for a second, representing my buy point. So if right there I buy, I could then immediately put my stop somewhere below the triangle or somewhere below the breakout point. So I'm buying here, and I'm just going along for the ride because I know that the stock will have a tendency to run. Now, if the stock breaks out to the downside instead of the upside, the same concept can be applied. The stock will run. If it breaks out to the downside below support, it'll generally go to lower levels. So for the short seller, this becomes a great trading candidate. How many of you, I don't know if I could see a show of hands here, but how many, just type a yes into the box there if you're an option trader or if you've ever traded options before. Just type in yes or a Y. So I make sure, okay, Rob, Lance, okay, Ash, okay. All right, so for the option traders, these triangles become entry points for you as a put buyer. So for instance, if the stock breaks out here, you're buying a put and the stock is going much lower. Now, my subscribers who trade options, I have an option trading service. I have an equity trading service too, but the option traders, we hit a home run with CMG. I don't know if any of you have been watching Chipotle Mexican Grill, ticker symbol CMG, but the breakout occurred on CMG, and we went long the puts. And this is actual fact. I'm not making this up. We made 24% in 2 weeks just on our option trade, and it's still moving. It's still working in our favor. So, I'm not just showing you this because it looks good on a PowerPoint slide. We do this. This is what we do to trade and make money, and it's very, very exciting because it's such a reliable concept. Okay, now going to an actual, what it looks like on the chart, this is it right here. And you can see, again, the sellers, again, up here, S, they're pushing the stock down at certain key points. You see that right here. And they are pushing the prices lower to lower highs. Now, this is a symmetrical triangle. This is where not only are the sellers pushing the price lower each and every week or almost every other day here, but the buyers are pushing back. And you can see here that we're seeing higher lows as the stock goes higher. So remember what I said. I used the term price squeeze, right? The price is getting squeezed at the end of that triangle into a very narrow price range, and then eventually the stock broke out to the downside. Now, Ash said, do you have any concerns about entering on a gap? Well, Ash, if you could hold on just for a couple of more slides, you're actually almost reading my mind here. I will be talking about gaps in depth here, and I'll even show you how to screen for those gaps as well, because I love gap trading. That's a whole nother strategy. Okay, so that is the triangle pattern. Now, this is what symmetrical triangles would look like on an actual chart. And you can see here, again, we have that price squeeze in this triangle. You see that? And what happened right here, this would have been an entry point right there, right where my hash mark is. Now, understand that this particular strategy is very, very short-term in nature. This is not something that the investor would get in on. Now Lance asked a really good question. What's the exit strategy? And I'm going to answer that, Lance, right now. When you buy on a breakout, you immediately set your stop somewhere below the breakout point. But as the stock goes up in price, and let's say in this case, let me go back and erase these here. Let me erase that, and I don't know if it's erasing here. How can I erase that? All right, I'm just going to go with that one. Leave that in there. Maybe it'll... Okay, so let's say in this case we see the stock is reaching a resistance point up here. So we get in and the stock goes up. What you do at that point, Lance, is you trail your stop up. You could do this manually, or you can do this in a lot of the trading platforms. You could set a trailing stop. So what happens is as the stock goes higher, you move the stop up, or the computer moves it up for you. And then what happens is you wind up making money on the difference between your entry price and your sell price. Now, the spread could be a percentage of the price. It could be set at a penny value, actually. You could say, okay, I want to trail the stop 10 cents below the bid price of whatever the stock is trading. So as the buyers come in and the bid price increases, your sell stop it trails. Yes, it trails. You're trailing it. So here's another example where we have a triangle where the buyers are kind of pinching the price, and right here we buy. Okay, we set our stop somewhere below the buy point using the 1% rule. My video explains exactly where to set that stop based on the formula that I give out. So remember, go to themarketguys.com and watch that video, take notes, and put together your formula. And then so when the stock starts moving up, like it did here, you then trail your stop up with the price of the stock as well. And that's how you make some money. So again, we talked about the breakout on the trading channel, or in the trading range. We talked about the breakout on the triangles here. And we also talked about where to set the stops. Now, remember, again, that the stock selection process is it should be a simple process. And I have to be careful when I address this because, see, the way our brains work as human beings, we want to learn. And a lot of times we tend to overcomplicate things. The more data we get, the more complicated we make it. This should not be a complicated process. It's a wait for the signal, react on the signal, follow through with the stop, and protect the position. That's a rhythm that you should be getting into to buy and protect, not so much buy and hold like a lot of people did with investing, but buy and protect. So again, this example where my buy point is going to be right here, I'm going to put my stop level right below that, and then as the stock moves up, I could trail it. Now, another point I'd like to make is that if the stock goes up and all of a sudden is showing a very negative candle, which, by the way, I'm doing a whole nother presentation on price patterns. So, in other words, if you see the stock go up and you have not been stopped out, but all of a sudden you see a bearish engulfing pattern, for instance. You see a bearish engulfing pattern, which is a very bearish signal. Or you see what's called a hanging man or an inverted hammer, or you see something that looks very negative, you could just get out, take your profit. You do not have to wait until the stock has stopped you out. Now, Lance says it looks like the second triangle would stop you out quickly after the red candles. Well, not if you bought here. If you bought right on this green candle, it did not drop down to here. So this would have been a very good and profitable trade. So another thing is if you've ever used stop loss orders, one of the biggest mistakes people make is they put their stops too close. They put their stops too close, or they put their stops right on a support level, or not far enough below a support level, and they get whipped out. So you could just keep going in, and these are just examples on how to analyze the triangle or identify the triangle pattern. Okay, now this goes back to Ash's question with regard to gaps. Now, again, gap trading, I have to say, is one of my favorite trading strategies because they have been so consistent for me. A gap, let me first identify what a gap is. A gap is a break between the prices on a chart. And it usually occurs because news has come out on the after-hour market. So, for instance, if Apple closes today at whatever price it closes at, and over the night, news comes out that, oh boy, they're going to disappoint on earnings or whatever it may be, or maybe Apple analysts have downgraded the stock. The next morning, the stock is going to gap down. It's going to be trading at a price much lower than where it closed the previous day. So these gaps form on the chart. Now, an interesting thing about the gaps, and this is my own analysis over 35 years, and I'm going to give you an exercise to verify this on your own so that you can see with confidence how well it works. But it's like an 80-20 rule. 80% of the time, gaps fill. So here, let's use this area over here as the example. This is a gap where I just drew the circle. Stock obviously went up after that, and then it gapped down. We can see the gap down here. But after it gapped down, the stock came right back down to the level it left when it first gapped. You see this? So in this area right here, that is the gap fill point. And 80% of the time, gaps will fill. Now, the other part of the equation here is that after the gap fills, 80% of the time, the stock reverses the other way. See, so again, you can see that the gap has filled at this price level right here, but once the gap filled, it went up and reversed. And this idea about gap trading and this 80-20 rule for gap trading, it gives us a lot of opportunity for for trading because the gaps actually give us the targets. So for instance, stock trades down here. All of a sudden you see a beautiful hammer pattern right there after the gap is filling right here. You see that? This becomes an entry point right there. Boy, I like that hammer. The gap is filled. Chances are it's going to reverse. Boom, it reverses. I get involved. Boom. So I buy the stock right here. Now I see a gap up here. Here's my target right here. I'm going to put a T for target. So now that I buy at this level down here, I'm willing to ride that stock up until it fills that price target gap fill point, and then I get out. Now, if you, I was thinking about this before I did the presentation. If you like, if you want a sample of what I do, I was trying to decide whether or not to give you 1 or 2 samples. So I decided I was going to be very generous. If you want an actual trade alert sample from me, a live one, I'm talking one that I'm going to be putting out this week and next week, just go to themarketguys.com down here and type in an email to me and just say, sample please, or I'll know what that means. You don't even have to put your name or anything in there. Just put sample please, and I'll send you the next 2 live trade alerts. Chances are that trade alert is going to be driven by a gap strategy, and at the very least, it'll be driven by the moving average crossover strategy. That's how often I use them. So when I send out a trade alert, what it looks like is it's a PDF document, but I send a video alert with it so people could follow along with my voice and look at my charts. And so what you'll see on the alert is the entry point, but you'll also see how I calculate my risk for the exit strategy and using the 1% rule as well. So if you do want the next 2 weeks of samples, just send me an email and I'll get that out to you. I promise that you're not going to be disappointed on that. And again, it's free. Okay, so I'm looking for questions. What time period do you like to trade on? Well, Lance, I am a swing trader. I used to be a day trader when I was a professional trader. When I traded for Bank of America and Quick and Riley and Nash Weiss and all those companies, I traded with bank money. So I would get in and out during the course of the day based on the order flow that I had at the time in my book. Now, let me just give you an idea of what that is like. I would have to monitor 50 to 70 stocks at a time during the course of the day, and I would have to trade 50 to 70 stocks depending on what my positions were every single day. It was extremely stressful to do that because I'm in, I'm out, I'm in, I'm out. But what would happen is my time frame for that particular position that I held was by the minute. I didn't have the luxury of holding positions overnight. I would have to be flat at the end of the day. But when I started trading my own money and left trading the NASDAQ market and started teaching people how to trade, my time frame shifted so that I was a lot more relaxed. Now it's anywhere between 3 weeks and 3 months is usually my time frame because I'm not looking to make pennies anymore. I want to make dollars. I want to make big scores. So I'm not looking to just squeeze out a couple of pennies and move on to the next stock. I get into a stock and I want to make a 24, 25% return on my money. And I want to do it with confidence, and I want to do it with certainty, and I want to do it with a plan that will allow me to sleep at night with regard to managing my risk. I don't want to have to wake up the next morning and go, oh no, what did I just do? I don't like to trade the weekly options, Lance. I like the monthlies because there's still such a good concentration of open interest in there, and I don't have to rush the trade. So I do trade the monthly options, and I would love to go offline and have a conversation with you on that. I'd like to get to know what you do. But teaching people how to make money is what I do for a living. I have to pinch myself sometimes. It's such a great way to make a living is teaching people how to make money. But the only way that I could teach you is if you actually hold yourself accountable. You're the one that has to be your own boss. You're the one that has to, get up in the morning and say, oh, did I do the right thing yesterday or not? And so these, okay, that's fine, Lance. That's great. All right, so these are what we covered today. We covered the triangles. Wedges are very, very similar to the triangles. And we talked more or less about channel trading or rectangles. Now, look at the sheet that I gave you here. These are, there's still a lot of uncovered content that we could go into. I mean, that's how much there is to learn about trading. Some of the more popular ones, I'll put check marks next to them. Head and shoulders patterns, flags, and pennants, very, very popular. Cup and handles, that is become so much more popular than it did even 5 years ago, because people are starting to identify what a cup and a handle actually is. So what happens is, like a triangle, I'm going to draw this for you here in this small little part of the screen. You see right here, there's the cup, here's the handle, and this horizontal line is called the brim, or the rim of the cup, and the trade actually comes when the stock breaks out and closes over the brim of the cup. Like the triangle breakout back here, all right, the breakout usually takes place, and it's usually a very strong rally that follows on a cup and handle pattern. And believe it or not, depending on what technical signals you put into the computer, you could screen for cup and handles as well. So this is just, again, a small sample of what I offer, and I'm just so happy that TradeStation has allowed me to teach you folks. Remember what I said, themarketguys.com is where you would go to get these videos. If you go to the Market Guys website, there is a little tab right there, hard to see because I know it's a small screen, but there's a little video tab, and you could click on that and it'll bring you to the videos I mentioned. These are very, very short. They're only maybe 5 to 7 minutes long. So I have in there trading the gap. I have triangles in there. I have the 20-period moving average that I learned from Jim Robach. And I also lightly talked about engulfing patterns on this presentation, but you can get an eyeful there if you want to learn about engulfing patterns and how they work. Now, finally, if you would like a free copy of my next trade alert, there's my email address. Okay, and Lance, you can send me yours as well. I'm not a big fan of trying to sell you, my next book or whatever it is, in these sessions. Remember what I said. I have what I believe is one of the greatest jobs in the world. I get to teach people how to make money. But I want to tell you something. It's a little personal, but it's what really drives me in my career. If you could just imagine this for a moment, and there's going to be some people that can relate to this and maybe some others that won't be able to relate, but for years and years, especially when I was on tour with the Tony Robbins circuit, my largest audience was in London, actually. I had over 10,000 people in the audience learning about charts. Could you imagine that? There's such demand in Europe for learning how to trade the U.S. markets that Tony Robbins, he's a motivational speaker out of San Diego, he would bring me to speak on stage to his audience about making money on, using technical analysis. And it was such a great experience because people were really excited about making money. But when I went back to my hotel room, I felt, I can't even explain it. It wasn't like I was completely satisfied. I felt that there was something missing. It was like, here, okay, great. I just showed people how to make money. Oh, how great are you, right? But I really wasn't doing anything to make the world a better place. In fact, what I was doing is just promoting more greed. In not so much a good way. It was just people want to make money, money, money. But then when I shifted my line of thinking, I started challenging the audience, and I said, if I could show you how to make money, I'll keep doing that, and I'll do it with passion, as long as you make me a promise that you're going to do something good with the money. See, that's a big difference. So that's the big separator. If you could promise me that you're not only going to take care of yourself and your family, but maybe do something even greater with that money. Maybe, I don't know, go help some people who need food, or dig a well for people who are thirsty in some state or country. If you could take it to that level, you'll never lose the passion for making money in the market. And believe me, you will be a better person for it. So that's what drives me. That's why I keep doing what I do. I could retire any day here this week. I really could. I could go to my ranch in Cedar Key, Florida, and ride the horse for the rest of my life. But I really love to teach people how to make money. I hope you could one day develop a passion like that. And again, take that money and do something really great with it. That's my challenge to you. So thank you. And Sean, I'm not going to have time to answer that question. If you could send me that question to my email address, I'll be more than happy to take that up with you. Okay, folks? So have a great evening. Don, I'm going to pass it back to you, and you take it away.